Welcome to this week's Market Update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The big story was interest rates, and specifically what the Federal Reserve's patience on cutting them is telling us about the overall economy. Markets have shifted their expectations, accepting the fact that the Fed will move carefully before easing. And the 10-year Treasury yield, holding just below 4.3%, reflects that confidence, not anxiety. For our portfolios, bonds continue to offer attractive income, and the environment rewards exactly the kind of company that we're looking for, with pricing power and durable earnings. Oil prices climbing above $110 a barrel grabbed headlines this past week, but the signal underneath the noise is an encouraging one. The global economy is rather healthy and consuming energy at a robust pace. While higher oil prices add some short-term turbulence, they also support earnings for commodity-linked companies and reinforces why we build diversified portfolios capable of capturing opportunities across different sectors. The broader market's calm response tells us that investors are focused on fundamentals and quality businesses continue to hold up rather well. US regulators proposed meaningful changes to bank capital requirements this past week, and the news was well received. The largest banks in the country could soon have more capacity to lend, buy back shares, and grow their dividends. Regulators made clear that this is not about loosening standards. The financial system remains on solid ground, but rather giving well-run banks more flexibility to put capital to work. For our portfolios, this strengthens the outlook for our large-cap financial holdings, which are well-positioned to reward shareholders in this environment. Now let's look at what specifically drove our performance over the past week and why we remain confident in our current positioning. ARM Holdings was our top performer, gaining just under 13% as excitement around AI infrastructure continues to build. Rather than making chips itself, ARM licenses the fundamental blueprints that power everything from smartphones to AI data centers. This is a highly scalable asset-light business that puts it at the center of the semiconductor boom, and it's exactly the kind of competitively protected business that we're proud to own. The financial sector led our performance this past week, with stable rates and a pickup in capital markets activity, creating a strong tailwind for holdings like BlackRock, Goldman Sachs, KKR, and Fairfax Financial. Investment banks benefited from higher trading volumes and equity issuance, while the asset managers and insurers capitalized on higher rate environment. Diversified financial businesses with strong fee revenue are well positioned to keep delivering, and we remain confident in the sector's outlook. Our value strategy was a strong contributor yet again this week, with cash flow generative businesses in financials and energy leading the way. In a higher for longer rate environment, companies with real durable cash flows tend to shine, and our value positioning is built precisely around that theme. Looking ahead, here are some of the events that we're going to be monitoring that could shape markets in the coming week. Tuesday will bring the latest reading on the private sector hiring. Employers added around 9,000 jobs per week in late February. A moderation from prior months, but still not a sign of economic weakness. Businesses are being measured as they navigate costs and trade dynamics, and the job market continues to underpin consumer spending and corporate earnings. Also on Tuesday, we get the latest US manufacturing report. This sector has expanded for 7 consecutive months. This is a remarkable streak. New orders softened slightly on tariff impacts, but the domestic demand has stayed solid, and business optimism has actually improved. A manufacturing sector that keeps growing despite headwinds is a healthy signal for the broader economy. Thursday's jobless claims will give us another timely read on the job market. The most recent data was rather encouraging, with new claims falling to 205,000, which was well below expectations, confirming that employers are holding on to their workers. When people feel secure in their jobs, they keep spending, and that supports the companies that we own. Thank you for joining us, and we'll see you next week.